from a galaxy far, far away. We're joined by Mark Selby. How are you, sir?
Very good, sir. It's been quite a while since we've had our little weekly chat.
You may have seen what I just did there, Mark. This is clever. We spoke on May the 4th. As in, May the 4th be with you. That's what I did just then. This is quite clever.
There we go. Sorry. I've got to pick up my game.
Yeah, just saying.
Yeah, I got to pick up my game. Yeah.
Oh dear. I am so sorry for anyone listening to that on podcast.
Oh,
I needed to do it. How have you been? You good?
Good. Yeah, no, we've got our PEA out last week, which was great. And then we had we are lower carbon than 99.7% of all of the existing producers in the Skarn Associates carbon curve database. And Skarn are the ones that, BHP Billiton and a bunch of the other major companies use. So we wanted to make sure we were benchmarked by, the company that all the big majors use. So they'll feel comfortable with the number that's come up. And the key thing is that doesn't even include any of the offset from our tailings and waste rock, which eat the CO2. So I think we're well on track to being able to get to a net zero nickel cobalt level and a net zero iron level, which is
so good.
I've been intending all along.
So good. Well, we're going to talk about it. I think we haven't spoken for so long. What we did do, though, is we did put together that nickel conference, which was, thanks for putting all these people together. Amazing people. Feedback's been awesome as well.
Yeah, no, I thought it was great. It was an excellent. It was a good group of speakers, and Boyd Davis and Jeff Donald with MetSoc did a good job to put a good technical team together. And then, I thought the discussion with Ken Hoffman and Jim Lennon from Macquarie and McKinsey respectively, was excellent. So, and I'm glad to hear the feedback was good. Because again, I think, and the plan here is to roll it out to a bunch of different metals just to help people get that, one level of understanding a little more detailed so they can make smarter decisions on, copper or rare earths or uranium or whatever, around a range of metals, so they get less bamboozled by people who are using smoke and mirrors to obscure the real facts about their projects.
Yeah, we've seen a bit of that in the past couple of weeks as well. Yeah, no, we're actually packaging that up to make it a little bit easier for members and investors to actually access and understand. So that'll be on the next couple of weeks too. So thank you very much for that. But given I haven't seen you in a month, we better catch up on the old nickel market. How's it going?
Yes. Yeah, no, it's been good actually. We're back up through $8 a pound. Again, we were trading in a $7.50, $8 a pound range, and now we've moved up into a $7.80 to $8.20 a pound range. But again, it's good. The Tsingshan threw another curveball out there, and I think you're going to see every time the nickel price goes to $8 a pound with some momentum. I think you're going to see some announcement from Tsingshan about new supply or expanded supply or expanding further. They very much, want to keep nickel prices in this range to discourage, make it tougher for new sources of supply to come on. The big announcement towards the end of May was Huayou Cobalt. It was joint venturing with several other Chinese companies to do 120,000 tons of nickel matte, and along with that, 15,000 tons of cobalt. As we've discussed previously, this whole class 1, class 2 discussion was a bunch of malarkey, and at the end of the day, you can take laterite ore to whatever market it needs to. And so, this is just, more supply for both the nickel. And again, the implications here are more for the cobalt market, because this is nickel cobalt that I don't think most of the cobalt people were really expecting to see come into the market. So, we'll see what happens on the cobalt front going forward. And again, as we've discussed, the implications for HPAL, if you can, use existing technology, which is pretty low risk, low capital, maybe cost you a little tiny bit extra than HPAL, it's going to make HPAL projects, in the rest of the world, that much more challenging.
Yeah, it's interesting actually, because we saw both sides of that argument during the nickel conference that we put together, and we're seeing, but we're also seeing these kind of consistent this price level £8. It feels like. One, it feels with the price seems to be settling down around this new range that it's found itself. Mm-hmm. I think there's some great discussions going on between sulfides and HPAL, and people are asking those questions and trying to understand it a little bit better. So that's good. I'm just thinking back, if you look back a year, how far things have moved, right?
Yeah.
and the level of understanding, and the fact that some of these technologies, new technology, Tsingshan technology, are being talked about as a solution into this market. But it just says that I think it's front of mind. People are getting a little bit confident about the future. Are you feeling that as well?
Oh, for sure. I think I'm going to come back. I just want to, after we get through the nickel market bit here, just in terms of copper, what's happened there. The nickel market is in really good shape. Again, I think I've said time and time again on this platform is that one of the key numbers to look at in pretty much all scenarios is the stainless steel price. Again, that's still the largest portion of the market. And, if you see stainless prices moving higher, that means, demand for the product is exceeding supply. And that means there's going to be more nickel pulled into that supply chain. So, in China right now, despite all the noise about lots of supply from Indonesia, prices are higher than where they were at that short-term peak that we saw as we were heading into Chinese New Year. So, that's a pretty good sign that for, at least the next 3 to 6 months, we should see pretty robust demand going forward. And there's other indicators, that are reinforcing that. One thing that's interesting is nickel pig iron prices are still at a big discount, but supply is tight. So I don't know whether NPI prices are going to climb up. Again, if you're Tsingshan and you're trying to squeeze out your Chinese competitors with your great big Indonesian plants, that's how you want to turn the screws to them, is basically, keep that nickel pig iron price as low as possible. That makes their profit as low as possible. But you producing stainless in the Chinese market, out of Indonesia, are going to do quite well. Again, obviously, the other big piece of it is in the sulfate premiums. So again, they're not nearly as high as that crazy spike. They're almost as high as the nickel price itself back at the beginning of the year, but they're still well over $1 a pound. Some, massive increase in nickel sulfate imports off a very low base. But again, China is so short of nickel sulfate that it's actually starting to import some volumes, into the country, which again suggests that the sulfate market and demand from the EV sector, is really starting to pick up. And you're starting to see a drop off in LME inventories in the form of briquettes, which again, those are the preferred product form for people who want to use nickel, for dissolving. And then again, underpinning, the overall tightness is on the nickel pig iron side is ore supply, ore inventories. This is the time when Philippines ore imports ramp up, and they basically need to start building inventories for the 4 months of the year where the Philippines can't ship. And inventories are well lower than they were a year ago or 2 years ago. And, we haven't seen much of a build yet. So we'll see as the months go on, but, given how strong the stainless market is, it'll be interesting to see in a few months, where those inventories line up. So again, that triangle that we talked about earlier on in these discussions is again very supportive, for nickel prices. Again, we are going to see lots of supply from Indonesia, so I'm not expecting massive spikes higher at this price. But again, in terms of being well supported at these levels, I think that's going to continue, for the next 6 months or so.
I was talking to a guy in Indonesia. He's ex-BHP. He used to go and do their biz dev, and he lives in Indonesia now. Has for 10 years anyway. And he was talking about Duarte. Obviously, now they've announced that they're going to allow open pit mining. Big move.
Yeah.
Big move. Fantastic.
Yep.
But he was talking about the way that the Chinese had been sort of playing with Duarte in the sense of, getting concessions for him for lots of things, whether it be islands off the coast or, because he was trying to be friends with them, but he didn't have the political skills. He's a tough man, but not necessarily politically astute. And it'd be interesting to sort of see, because he's not going anywhere, very popular president. Because looking in, you go, our Western press goes, that's a nutter. The guy is insane. Internally, he's got 80% approval ratings.
Right. Yeah.
Right.
Yeah. Oh no. Again, it was a country that was, basically, looted by, a ruling class that was, horribly corrupt. I'm not sure it's really any at least less corrupt, but again, I think the optics of it, are that at least, people aren't quote getting away with things, whatever those things are. So again, I mean that's the big thing with nickel supply is with all the growth coming in Indonesia plus the Philippines playing an important role. you've got two countries, that will probably be close to 65% of nickel supply by the time we get to 2025. And those are countries that have never hesitated from meddling in their mining sector. Again, the prospect of putting on a small tax, and generating a huge amount of revenue for the country, I think it's just going to be too tempting to pass up. Jokowi in Indonesia has been pretty good so far, but again, never ever forget geopolitics, and never, and there was things that happened for many, many decades. About once every 10 years, there used to be something would happen, and the Chinese section of Jakarta would go and get looted. There's a deeply held feeling in a lot of Southeast Asian countries that the Chinese minority there is again sort of stealing and controlling parts of the economy. And so, every once in a while, the resentment builds up, and that's what happens. So again, politically, if you ended up with a Trump-like character in Indonesia at some point in time, the opportunity to go beat on some Chinese controlled companies, would be a very easy target to go after. So we'll see. Again, you don't like to see that kind of stuff happen, but I think it's a real supply risk that a lot of people are going to have to factor into their supply chain decisions going forward with respect to nickel.
And not just Asia, right? That's happening in a lot of places. We had it here with Brexit. People felt they could suddenly say things which you may have thought but wouldn't dare say in public, and people are. You're seeing it in the States as well. I mean, it's human nature coming through here. As things get a little bit tough, people behave less than admirably. Yeah. Well, but let's not go geopolitics too early. Copper. No. Should we talk about copper? We started talking about copper.
Yeah. No, I think. Yeah. I mean, again, in terms of sort of the sister metals on the LME, copper hit an all-time record high, passing through where it hit back, in the early part of this decade, got up to, nearly $480 a pound. Now it's fallen back down, and it's gone back to that sort of $10,000 a ton level, which is $454 a pound. And what's interesting, and again, I think I don't know if I can promise for next week, but in the next few weeks here, I'll look at some of the indicators in terms of have we seen the best of the market. Again, called the bottom last May. And I'm starting to see some signs that we are really at a top here. So one is, as copper prices were setting new all-time highs, you saw a bunch of commodity analysts falling over themselves, talking about how great the fundamentals in copper are, how long, that this is going to be different this time. It's sustained, that there's massive, supply issues in South America. There's all this new demand coming and, but, again, prices have fallen over. Import premiums into China are at the lowest level they are since 2012. So I'm going to go spend some time digging up some research in terms of scrap discounts, and a few other metrics to say that, okay, again, there are some real supply issues in South America. So I think perhaps, can they stay at these types of levels for a longer period of time? Yes. But, is there going to be a whole new other level higher from here? Again, some of those behaviors that come out, are pretty indicative of we may have seen, we might have seen the top here. So, but again, not saying that for sure. Let me do a little more homework and get back to people on that. But again, you don't make money until you sell your position. So just keep that in mind.
This is true. Well, look, we thought, we don't normally do this. We don't talk about Canada nickel much because this is about learning about nickel, okay? But we kind of earned some brownie points by doing the nickel show. So well done. I do want to talk about your PEA. I'm going to make an exception because there's a few things that I've seen. I obviously like you to talk about it which way you want, but I would like to ask you some questions about some of the things that are being said in the market, some of the perceptions of the numbers, the way you're going about it, your focus, the strategy, et cetera, right? So because I sort of understand because we talk offline and so forth, right? But I want people to understand why you've done it in the order that you've done it. So why don't you start with some top line numbers and we'll then dig in.
Excellent. Yeah. So no, very, very, very happy with the outcome. So $1.2 billion after tax NPV, 16% IRR. We're going to produce nearly 2 billion pounds of nickel, or 860,000 tons for you who think in metric, over a 25-year mine life. When we're at peak production, we would be the largest single nickel mine outside Russia and China. We'd be the fourth largest integrated nickel sulfide operation globally, and we'd be the largest base metal mine in Canada. And we're just getting started, because all of those numbers are based on a resource that we locked in last October. So we've been drilling since then. We're going to keep drilling. And our feasibility study should be coming out sometime in mid next year. And so, by the time we get the feasibility study, we expect that resource to be 50 to 100% larger than what we have today. And we're not really, again, we'll be 120,000 tons a day of ore processing, which would make us the second largest base metal mill in Canada. So I don't think we're going to expand that any further. So effectively, the capital is fixed. And so now we get the great opportunity of, we've got, 50 to 100% more ore to sequence in our mine plan. So we can put a lot more high value, lower cost ore earlier in the mine plan, with all that incremental cash flow dropping right to the bottom line. So, I'm very excited about the prospects on the feasibility study side. Again, we're in less than 2 years from making the discovery on this deposit. So we're still learning about it and trying to unlock it. So we probably have another few points of nickel recovery here that we expect to do. And then we've chosen a stainless steel path, and we can talk about that in a few minutes more as to why we did that. But we're recovering 20 million tons of iron and 1.5 million tons of chrome alongside that nickel. And again, because this is, one of the first times we're looking at doing this, we think there's, significant room to improve those recoveries and payabilities that we're getting from a potential downstream partner, for that product. So again, the PEA for a lot of projects where they've been drilling it for 5 years, or they've drilling it for the third time in 20 years, and they finally get around to doing a PEA. We did it early because we had enough resource to come up with a pretty good project. And again, our goal here is, we think we're entering a nickel super cycle by the middle part of this decade. Because of our experience with similar types of deposits, we can advance this very aggressively, and we have advanced it very aggressively. And so, our goal is to get this thing into production, by the middle part of next year.
Good. That's that. There you go, folks. There's what's happening. It's the big, advertisement. It's big, and it's going to be even bigger, right? So let's get into the strategy bit. Okay, you have, because I want to get into some of the numbers, right? Because people are knocking you, going, a company of your size can't put that CAPEX together. It ain't going to get funded, right? So you've got to give yourself some options, or you've got to be able to explain that to people. And the first thing you do is say, hey, we're not going to focus on EV. We're going to focus on stainless steel. Was that the right thing to do? Oh, yeah, no, there's been again, and I heard, unfortunately, a competitor at an investor presentation in New York was saying, oh, these guys have given up on the EV market. There is nothing farther from the truth about those statements. Fundamentally, we want to build the highest value project for the company today. That's fundamental fact number one. Fundamental fact number two is there is not a demonstrated concentrate to EV processing design right now that I need to be able to put into a PEA to get that sign off. I fully expect that to happen by the time, hopefully, we get to feasibility study, and definitely by the time we get this project built and in construction by the middle part of this decade. So I need to take the best option that's available today. And again, in terms of being able to negotiate, because again, I will be one of the largest new sources of nickel outside of Indonesia and the Philippines. So I need, and I want, as many options to deal with the stinky old smelters and refiners who have screwed over, junior nickel miners for decades and decades. I need to have the most negotiating leverage with the shiny new players on the block, that are the EV players, right? And again, I intend to be a significant long-term, multi-decade supplier to the EV market, but I'm not just going to do it as a favor because I want to hopefully, meet Elon Musk at some point in time, or some other, major EV, producer. I want to do it because I want to make money for my shareholders. So I went with another option, using proven technology. I'm just going to use the same RKEF AOD that Tsingshan is turning out, and other Chinese players are building at a rate of 2 to 3 a month in China. And I'm going to order 2 of those.
I can drop them into Timmins, and metallurgically, there's no issues using a roasted concentrate and magnetite concentrate that has iron and chrome, which are the two elements you need to make stainless steel, and looking to produce a whack of stainless steel, in Timmins. So we could do that, but again, we have the highest grade nickel concentrate in the world, is what we expect to be able to produce, which should be the best feed for the EV sector. So it's about, what we did was proven technology today that we can, demonstrate hand on heart to the market that's going to work. I'm not planning to build a nickel refinery for $100 million, next to a mine where the best example of that technology was Long Harbor, that cost $4 billion to build, when Vale built it. This is technology that works with feed, with the feed that we are able to provide. And I've given myself the maximum optionality in terms of striking the best deal for the mine, to maximize the return on that mine over the next 25 years. So that is the strategy. It's not abandoning the EV sector. I just made sure I had 4 aces in my hand before I went to have those negotiations.
Right. Okay. And as an ex-banker, I want to hear you say, I'm using proven technology. I don't want to hear this is a new technology. I get nervous at that. Okay. So I understand that. But you're also banding around highest grade, best, biggest, which is you want to hear all of these things, right? You do want to hear all of these things, and you're going to have to deliver on all of those funds. But I want to look at margin, price, premium, those sorts of things. So you're looking at, which obviously stainless steel is great, but where are you selling it?
No, I'm not competing against the Chinese. Again, that's what people need to understand. There is not one single price for any commodity around the world. There are local markets with local attributes. And the great thing about in nickel, and the massive opportunity that really no one has ever taken advantage of, is that, for the last period of time, the US and European stainless markets have gotten increasingly protectionist. And so the premiums in these markets, when you look at it as a per pound of nickel basis, are massive. So, in the United States, it's between $5 and $6 per pound of nickel is the premium, on the same basis on which you would look at a sulfate premium, which has averaged $1, during a similar time frame. Even if you knock off the conversion cost of a typical stainless mill in the US, they're still making several dollars a pound. And again, it's proven technology to be able to make stainless steel. There's nothing new that we're going to be doing to be able to do it. Again, people haven't taken this feed historically in, but there's mixing nickel and iron oxides together to make is effectively what laterite ore is. Ours is just going to be a lot higher grade than what they dump into it. Indonesia. And so again, from a carbon footprint perspective, it'll also be a lot smaller. That's what's there. And with our tailings and waste rock, again, we've got some ability to absorb additional carbon and still be a zero carbon producer.
Okay.
And in terms of, and the key thing is in terms of margin and cash flow, we'll be producing with the big iron and chrome credit. Our cash cost is just over $1 a pound. And the more important number, and again, this is where these large long life open pits really excel, is our all-in sustaining cash cost is less than $2 a pound. So unlike a small high grade deposit that has to continue to find the next year's resource and then develop out to it, we've got a large resource base, and so our all-in sustaining cash cost is going to be relatively low. And in terms of cash flow metrics, we'll be producing 270 million free cash flow annually over the 25-year period. So put whatever multiple you like on free cash flow, and that's the kind of value that you're going to see for a project. Again, just getting started with last year's resource.
Okay. So yeah, right. So you put a stake in the sand last year and said, right, well, you're going to use this information. You've been drilling. You're going to continue drilling. This thing can only get bigger as far as you're concerned. I get it. But I'm looking at the IRR, 16%. Doesn't seem very sexy. Oh yeah, no, that's my number one bugaboo with retail investors. So again, been in the business for 20 years, worked for some large companies, worked for some mid-tier companies. I can assure you that, large scale, multi-decade projects done by real engineers, not engineers hired,
by a junior mining company to just come up with a number that have basically make-believe capital costs and make-believe operating costs. When you have a project that we're going to build and using an engineer who actually builds projects, and getting those capital costs and those operating costs. And again, I would encourage anyone out there to go benchmark, both those numbers against real projects that are out there. And I think they would hold up very, very well. Mid-teens IRRs are good numbers. Yes, there are deposits like Arizona mining, that, did get 20% plus IRRs, but those are, you get one or two of those a decade in terms of great, massive, high grade base metal discoveries. In reality, the only other projects that get 20-25% IRRs are smaller, higher grade deposits or larger deposits in some very politically challenging jurisdictions. And so, when you take the political discount off of those returns, again, they would probably come, somewhere in line to what, the kind of returns that we're getting from our project.
Yeah, I mean, again, I think from my banking days, I think we were looking at 12 to 14% as being pretty good for projects of scale, right? And multi-years. Yeah. So I know, okay, there's a bit tongue in cheek when I was asking.
To reinforce it is, again, the conversations with people we're having, in terms of the kind of people who would provide project financing for these kinds of projects, the kind of people who would be strategic investors in these kind of projects. Again, we're very happy, with the kind of numbers that we're showing, in terms of capital costs, operating costs, and returns. So again, those of you who are concerned that we didn't hit 20%, wouldn't be that, this is exactly where we want it to be.
20% plus is PE territory. Okay, just say that for anyone watching that. So that's where you can position in your head. This is good. So the types of people that you'd be talking to about this, how would you be approaching those conversations in terms of the way that money comes in, the type of money it is, the terms attached to it? Just broadly.
Yeah, so
I know you can't give away the trade secrets, but broadly.
Yeah, no. I mean, again, in terms of again, in my past life with Dumont, with RNC, there were a few points where the nickel market was, looking at could support project development, and we had Rothschild as our project finance advisor. We'll be appointing a project financer for this project, in the fall, and we'll be kicking that process off here shortly to get that player in place. But, again, we work with Rothschild for a better part of a decade. And, traditionally, what you see today for larger scale projects is, you have a senior debt facility that's, basically 60 to 70% of the capital, depending on, on the, project risk. Is this something that's been built 25 times before? Then you, in a lower jurisdiction, you might get up to 70. If it's something that hasn't been built that often, again, there's not 15 large scale low grade nickel mines in operation. So we'll be closer probably to 60% debt capacity, to be able to put that together. And that would be a syndicated debt facility. And then you have a project bond in the Scandinavian bond market's been successful in terms of raising those kinds of things. For one's a little lower cost, but a lot more structure and a little more complicated to manage. And then the other one comes with sort of fewer constraints in terms of, what you finance, but that flexibility comes at a higher cost. Then in terms of partner discussions, you've got, again, you can joint venture at the project level. You can have a strategic investor coming in at the asset level. And again, the nice thing for us is, there are sort of the traditional buckets of companies. So there are the Asian trading companies in Japan and Korea. And again, in various past lives of mine, I have relationships, in each of those. And now that I have a project definition that I can show them, I can start to have those discussions. That's why it was so important to get this PEA done as soon as possible. Again, even though it's going to get much bigger and better, it's just good to have some numbers that I can have a discussion with those groups of people. Then you've got the larger mining companies, mid-tiers, who again, may want to partner on a project of this scale, or to take it out entirely. We'll see how we go on that front. And then you've got, the thing that is very real is, there's a whole EV supply chain that's desperate to lock in long-term offtake. And so, again, now that I have a real project that I can say, this is how much nickel I'm going to produce, over this period of time, I can go have those conversations with them today, and so between that maybe streaming if we, again, once we sell nickel to the EV sector, we should be able to capture the cobalt PGMs from that. So maybe we look at streaming some of those as a small fraction of that. But, that's how you put together the equity component of it, and away you go.
And do you have to, look at junior companies, small companies need to look at all sorts of kind of cute structures because they're kind of hampered by the ability to go and raise cash, the cost of that cash, the asset that they've got, which some people may want to securitize against. The options aren't there for them. When you're kind of dealing with a project which is, biggest and best and everything else that you describe it as being, do those sorts of negotiations have a sort of different color to them, a different tone to them? Because you're talking with a different set of people. You're not having to scrabble around and piece together 20 different ways of putting funding together.
Oh, and again, with Dumont 7 years ago, that was, that was definitely the case. So I really know, I know what that looks like. But, in today's nickel market where you have, the entire various groups of people all pro nickel, where they were not pro nickel 7 years ago is, the fundamental thing is you've got a lot more people at the table, and the more options you have, generally, the less costly it is, for you to do that. Again, because there's another class of companies that, I know $1 billion as for CAPEX sounds like a big number relative to a lot of junior mining projects. But the reality is that most multi-$100 million EBITDA options in all of the majors or mid-tiers portfolios, they're looking at least that much, and if not, probably $2, $3, $4, $5 billion, for the scale of projects they have to build. So, writing the equity component check for a project of our scale is not going to be an issue for those groups. And again, the EV supply chain, they're spending billions, if not tens of billions of dollars on the downstream. Again, $400 million, for equity check to get a long-term offtake is not going to be, crazy kinds of investments for that group. So no, it will be a remarkably, these things are never completely simple, but it's going to be a much, much easier process than last time. And the other part too is, again, as a shareholder, some junior companies have blown their brains out just to get the package together to be able to build the project, and they top it all off with, to get that final thing is they do the equity raise that's 140% of the current market cap, which, eliminates the ability for ever to earn any upside. I have zero interest in this. We will go to the market. We will test the market in terms of getting this project financed and built ourselves. If that's not there, then we will sell it to somebody. I'm not going to do something that's going to have any negative impact on the equity value of this company. I would like to be involved in developing this project all the way through. But if the market's not going to give our team the capital to do it, I will gladly, sell the asset or all or a portion of it to someone else, who does. So
okay, because you put the PEA together,
yeah,
with the data you've got from last year, with a strategy which just isn't necessarily feeding into the EV narrative and so forth, but just to get some numbers on the table, give yourself some options. I understand that.
Yep.
When you're going and talking to the financiers, you're saying, well, hey, we've got plan A, but we also got plan B over here. Are they thinking that's a stroke of genius, or are they going, oh, mixed messages? What am I buying into?
No, what were they at the end of the day? As long as what the financiers care about is the product can get sold at the kind of values that you expect in your feasibility study or PEA that you've based it on. So they're going to look at the assumptions that we've made there and determine whether it's a reasonable or not reasonable proposition going forward. So, that's it at the end of the day. And by giving yourself more options, you increase the likelihood that you actually are going to achieve those kinds of payabilities. And so, that's, again, in the discussions with people who, provide this kind of finance, they were pleasantly surprised and supportive of, this kind of approach.
So just again, back to this kind of margin question again. So if you are selling into stainless steel market, you understand because the information is there what sort of margins you're going to be able to make. Let's say it's at $8, right? You understand what margins you're going to be able to make there. If you're selling into the EV market in the future, there's an expectation that prices are going to be, because you're selling the high quality, are going to be higher. Margins going to be higher. So clearly that's much more attractive. Have you got a idea of whether it be now or let's say 5 years time, because the EV market will be more realistic in 5 years time, and you're producing in 5 years time, what's the delta between the premium that EV would pay versus stainless steel, or is it all just in the cost of the financing with a strategic partner that you're gaining the most benefit and leverage?
Yeah, where it'll come down to is actually more the latter. I think the sustained premiums that you see in the U.S. and European market, aren't going to go away. The fact that, all of the stainless steel that's coming from Indonesia and China, it has a massive carbon footprint. That's just going to be a whole other sort of non-trade tariff barrier that, the Europeans and US are going to use. And so, and again, there's not 15 new stainless plants. There's not 15 new nickel mines opening in the United States anytime soon. So I'm pretty confident that, those premiums have been sustained. They are sustained today, and they will be sustained for a period of time. Again, this is what happens in regional commodity markets, where there's real barriers to entry that are in place. Lost my train of thought. Number one was on the trade barriers, and then the other part is in terms of EVs. Cobalt sulfate trades at a discount to cobalt metal in the market today. I know everyone is all fired up about how big these nickel sulfate premiums are going to be, and my view is you're going to make about 30 to 40 cents a pound on these long term, but there are production paths, where you could end up with nickel sulfate premiums that are actually below the LME price. Again, just like we've seen in cobalt. This market today is one size. By 2025, it's going to be probably about 5 times as large, and by the time we get to 2030, it's going to be 10 times as large. So it's again, I have a pretty good sense of what the U.S. and European stainless markets are going to look like. I have I have a view as to what the EV markets are going to look like, and lots of people have views as to what the EV markets, but how that's going to unfold over the next 5 to 10 years, is going to be, a pretty challenging discussion. So if I can go to a financier and say, look, I can make a pile of money selling to stainless steel. I can also have a path to get these units into the EV market, and I get the cobalt PGMs paid for too when I do that. Those are the kind of things that make them feel a lot more comfortable that I'm not betting the farm on a path that no one really has a lot of visibility on at this point in time.
And let's talk about the importance of the financier that you choose, because again, down at the lower end of the junior market, there's some, the names that we all know, and it's a little bit easy street to me. It's like lazy. They just want to get the money in. So they're going to recommend that you dish out warrants. They're going to recommend that whatever price that makes it easy for them to sell, because a fee is better than no fee, or they want some sort of certainty around that. That definitely happens. And you CEOs tell me that all the time. It's like, well, I know I could have got it cheaper, but the broker was telling me this was the price to market at. Okay. Where you're going, the types of quantums you're talking about, the selection of the financiers is going to be critical, because it's going to affect the cost of your money, not just the debt, not just the debt equity ratio, and if there's any other kind of fancy structure stuff in there, but also the cost of each of those to you. So but you're going to have to give them. You're going to have to work with them and give them something. So what do you think the expectation of you is? Let's start with that at that end of it.
Well, again, where you get sort of the best terms and the most support is, again, historically the larger base metal projects, have almost always had an Asian trading house partner. Again, they want a portion of your offtake, and again, it's at market terms, but they want offtake for a long period of time to, feed their customers, who they market to in Asia and the rest of the world. In return for that, though, you get exposure to, from a financing perspective, to, Asian banks, Asian export incentive programs, that allow you to get a much lower, cost of capital to get there. And again, these things, those don't get done in a week. Those are, 1 to 2 year types of discussions. And again, that's why even before we get the feasibility study done, we're going to get our project financer advisor in place next September. So we can start to have initial discussions based on what the feasibility study might look like to start to warm up those banks. So when the feasibility study is ready, that we can then, move those again as quickly as you can. But no, there's again, that's, we worked with Rothschild last time with Dumont, and we're going to work with, a same quality as advisor at this time. And again, having that kind of quality advisor as an endorsement, of your project's capability. So many people, wonder why Dumont didn't get advanced. Again, it was market conditions. Nobody wanted a large nickel project, 10 years ago. It's 100% different today. And again, expect to work with, as high quality a group as we did last time in terms of being able to put that package together, which again, just opens as many doors as possible. And again, it's all about getting the lowest cost, most flexible financing package that you can get.
And it's a really important point because people don't necessarily think about the cost of the money. They focus on the fact that you've got money and then forget to kind of look at the terms, the constraints, the securitization, the kind of the handcuffs that are put on companies sometimes if you don't pick the right partners, strategic partners. You're not in control. I think the thing is I picked up today is these paths that you've got, the ability to be able to turn to someone and say, okay, well, if you're not a buyer, that's fine. I've got another route over here. So you're not being bound by, I guess, the norms of how the market behaves typically. Yeah, we're not stuck in box A, and box A is our only alternative.
Again, the more real alternatives you provide yourself, the more negotiating power you have, and generally, more negotiating leverage translates into lower cost and more flexibility in terms of, whatever financing solution you put together. Again, like I said, there's as much, to be able to do that, the overall cost, again, with a project of our scale, of being able to shave basis points off the financing costs, or, having more flexibility around some of the financing terms, are critical. When you multiply anything by 1 billion, it turns into a pretty big number pretty quickly. So, it's as important as detailed engineering is to reduce the technical risk. Detailed financial engineering to make sure you manage the financial risk is just as important when you get to this stage of the project.
Okay, and I appreciate you running through that. I'm always fascinated about in terms of the granularity around how you go about putting all of these moving parts together and the timing and so forth. And I get you're trying to do it in an accelerated time frame. You talked about exploration. You've been drilling. You've used old data. You've been drilling. You continue to drill. Yeah. Where is all that information? I haven't seen anything.
Yeah, so we announced the discovery of McDermott. Again, assays are pretty backlogged. So we've got our first 3 holes in McDermott, which is an entirely step-out target, is there. And then, we've been drilling the western extension of our main zone. We've got infill drilling in our east zone, and we've got results from our north zone. So, over the next month, 6 weeks, you're going to start to see some real news flow on that front. And again, our objective here is to have a feasibility study resource, that'll be 50 to 100% larger than what we've got, for the PEA. So, and again, what we're seeing today, I wouldn't throw out those numbers if I, didn't think that we'd be able to hit those kinds of numbers.
And the same sorts of recovery, same sort of metallurgy. It's just more of the same.
It'll be more average grade material. Like we haven't stumbled into another super, high grade zone at this point. But the key thing is, we used in the PEA, we used of the 1.1 billion tons that were available, we used 900 million tons of that in the PEA. So I can tell you that there's with the stuff that we'll be finding will be definitely better than the worst 100 million tons we've got. Will be definitely better than the worst 300 million tons that we currently have in the plan. And so that delta in terms of value, whether it's higher, whether it's better recovery, lower costs, or both, is all going to fall to the bottom line. So again, it'll be fun to see how that feasibility study mine plan comes together.
Yeah. Well, it will actually. Well, look, Mark, we've been following you for a year and a half, nearly 2 years. Nearly 2 years, I think. It's been fun so far. Hopefully more of the same the rest of this year. I always enjoy talking about a good story with a good team who put it together properly. No BS, none of this promotional crap that we see elsewhere. So keep at it.
Thank you, sir. No, and as I said, it's been 20 months, I think. So in another 20 months, I think we've moved a huge distance in that time, and I think we're going to move another huge distance in the next 20 months. So no, it's been exciting.
Brilliant. Okay, we'll see you next week, Mark.
Thanks, Matthew.